to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss our exclusive interview with Axel Merk of Merk Investments. Axel weighs in on the recent sell-off at the end of last month in gold and silver and helps us put it all into perspective by zooming out and looking at the big picture, something he does so very well and a big reason why we have him on as a regular guest on this podcast. Axel also gives us his unique view as an investment advisor who has always had a broad understanding and acceptance of precious metals and what he is seeing on his side in terms of more widespread demand from the retail investment crowd. Axel and Mike Meharry also break down and weigh in on the recent increases in the gold price forecast that have been coming out from the big banks and what we should make of that. So be sure to stick around for an enlightening conversation about that and a whole lot more with highly regarded market insider Axel Merk coming up after this week's market update. And as a reminder, please download, like, rate, and subscribe to this podcast wherever you consume this content. Well, another big bank has raised its gold forecast. This time it's J.P. Morgan expressing more bullish sentiment despite the recent correction, raising its 2026 gold forecast from $5,055 per ounce to $6,300. J.P. Morgan analysts note that the 11% correction late last month ranks alongside some of the largest down days in gold's history, including January 1980's 13% fall and the 12% slump in February 1983. However, they emphasize gold bugs shouldn't be worried, stating that even with the recent near-term volatility, they remain firmly bullishly convinced in gold over the medium term. J.P. Morgan believes the uptrend has further to run amid a, quote, well-entrenched regime of real asset outperformance versus paper assets, unquote. J.P. Morgan analysts also lay out a case for $8,000 gold if households meaningfully increase their allocations. This underscores that while gold may become oversold at times, it is still significantly underinvested. There has been growing interest in gold as a portfolio diversifier. Last fall, Morgan Stanley CIO Michael Wilson said investors should consider abandoning the traditional 60-40 equity bond portfolio allocation and adopt a 60-20-20 distribution with 20% allocated to precious metals. On average, Western investors, institutional and private, currently hold less than 1% of gold in their portfolios. J.P. Morgan analysts estimate private investors currently hold around a 3% allocation to gold. If that share rises modestly to 4.6%, the incremental demand would challenge a market already constrained by limited new mine supply and persistent central bank buying. This could suggest a price range for gold between $8,000 and $8,500 an ounce, they suggest. To support this scenario, analysts say gold appears to be evolving into a core holding that is being rebased higher in investor portfolios rather than a hedge that occasionally spikes during a crisis. According to a CNBC report, a J.P. Morgan strategist recently said households are substituting duration risk bonds with more gold exposure. This strategist described it as a rebalancing between yield and purchasing power risk. The decline in purchasing power is a growing concern as the U.S. government plunges deeper into debt. The only way it can manage its borrowing and spending is through the inflation tax. Despite the cooling CPI, we see increasing inflationary pressure in the money supply. As for this week's market action, all the metals are having a real strong day here to close out the week. Gold is up a slight 0.3%, but it's in positive territory on the week thanks entirely to a nice advance here today of over $60. The yellow metal currently checks in at $5,070 an ounce. Silver is now about $5 higher for the week and trades at $83.02, with a whole lot of that advance coming here today. Silver is now up 6.4% since last Friday's close. As for the PGMs, platinum is up 4.4% to check in at $2,170, and palladium is up 2.6% to come in at $1,753 an ounce as of this Friday morning recording. Turning to the public policy front, the Utah Senate just shut down an Orwellian government gold scheme, joining Mississippi and South Dakota as the latest states to kill similar legislative proposals this month. The Utah Senate Government Operations and Political Subdivisions Committee voted on Tuesday to scrap a big government bill called House Bill 195. A similar variation of HB 195 had been vetoed by Governor Spencer Cox last year, with the governor complaining of its unworkability and vendor conflicts of interest. However, this year's version didn't get that far after senators recognized the vendor-inspired scheme as unnecessary and entangling. Here's why this is important. With all the enthusiasm about gold and sound money lately, some really bad proposals are emerging in a handful of states. Self-interested vendors have been trying to get state governments to go into formal partnerships with them to design and launch a government-run precious metals purchase, storage, and electronic payment system, and then going into competition with private businesses in the sector. The Utah Committee heard compelling testimony against the measure from the Sound Money Defense League and from Kim Coleman from Goldback Inc. Testimony explained how the bill is anti-free market, anti-sound money, and that there is no compelling state interest for the state government to entangle itself in such an offering, especially when similar services are widely available privately. Stephen Gleason, CEO of Money Metals Exchange and Money Metals Depository, testified that members of the public are generally uncomfortable with government involvement in their gold ownership or their personal financial affairs. He also warned against Utah transitioning from its traditional role as regulator to launching financial products that compete with private businesses, while also creating reputational and regulatory risks for the state. Prior to Utah this week, Michigan, Wyoming, New Jersey, Oklahoma, Iowa, West Virginia, Idaho, Mississippi, and South Dakota had already abandoned these proposals in response to various criticisms raised by policymakers, businesses, and investors. We'll be keeping a close watch on all of this here at Money Metals and keeping our customers informed, particularly if these power grabs come to their individual states. It's alarming to see politicians actually argue that government bureaucrats should be told to take part in the precious metals market and attempt to persuade the general public to deposit their gold and silver into government vaults and embrace a system of government surveillance and control. Well, now, without further delay, let's get right to this week's exclusive interview.
Greetings, I'm Mike Meharry, and I'm joined once again by Axel Merk. He is the president and chief investment officer of Merk Investments. How you doing today, Axel?
Good to be with you again.
Absolutely. Always a pleasure. I was telling my wife about you the other day, and I told her that, in my view, you are one of the more reasoned and level-headed voices out there. Like, I read your posts. I love reading your feed on X.
I don't know whether that says much about me or about the sort of people that you know.
Maybe a little bit of both, to be quite honest with you. And I'll be honest, I myself, I can get caught up in emotions sometimes, and I think sometimes that can be.
Don't forget that my speech is censored because we manage money. For those who don't know me, we manage a little over $4 billion in the gold and gold miners, and so the SEC keeps an eye on what I say. And
yes.
That said, since that's been happening forever, I've kind of embraced that, and so my more moderate analytical tone is kind of becoming part of.
Well, I think in this day and age, it's necessary because there's so much noise and I guess hype, for lack of a better word. So it is nice to see, kind of reason, breakdown, and analysis. So kind of along those lines.
I also try to be humble in that sense, right? I mean, nobody knows what the markets are going to do tomorrow. I like to point out the risks that are out there, and so people can kind of cross-check their own thesis against that. That's kind of how I see my role, rather than telling me, oh, gold is going to go up tomorrow or down tomorrow, because we ultimately don't know. I mean, I might be enthusiastic about it, or might be whatever, but but ultimately what I can do is kind of get you out of your comfort zone to think a little bit differently about that.
Absolutely. And I
Your
like
world.
to think. So along those lines, I kind of want to get your impression on the recent sell-off we had in both gold and silver. Very significant. I was looking at some of the percentages are in some of the top sell-offs for a day that we've seen in a long, long time. And I'm curious to how, from your perspective, how did you kind of view that and how did you react to it as it was going on? What was kind of your thoughts as you saw this happening?
Well, first of all, as we're speaking on February 19 during market hours, gold is still up over 15% year to date. And I like to just point that out in perspective, right? Yes, the volatility has been substantial, including some pretty severe down days. But at the end of the day, it's still up year to date.
Yeah.
And the way I think I have framed it to myself is that speculators are back. In the old days, when we were both much younger, gold bugs were big speculators. They loved the action. And then the meme stocks started to compete with gold and SPACs and crypto and everything. And so while the core gold investor was still there the different types of investors in precious metals, the speculator kind of lost interest during this protracted bear market. And as of about a year ago, plus minus, speculators have briefly been coming back. And what happens when speculators are back, when there's a trend, they pile on and with leverage if they can. And then you get the sort of stuff that we've seen in recent weeks. And of course, the initial sell-off has been, I think, a very, very healthy one, because you need to shake out the weekends periodically. But of course, the first wave isn't everything. Then there are more margin calls and margins are increased and the like. What I find very encouraging is one of our products that we manage is an open-end product, and we've had inflows on some of those down days. And unlike what many people in this industry think, I believe retail investors are actually quite smart. Maybe it's the sort of investors that we cultivate, and that may be the case. When I talk to our transfer agent in one of our products, they say, yep, our investors ask different questions than investors in other products. So maybe because we do a lot of education. But when I see others, take these as opportunities, and I'm not making an investment recommendation, then that is I think, very noteworthy that they are, quote unquote, buying the dip rather than throwing in the towel. And then, of course, as I don't need to tell you anything, right? The overall interest has been quite substantial, has been broadening, and it's incredibly noteworthy. And then, of course, I don't need to tell your audience anything, right? Even if the price of gold were to come down substantially, the margins in the miners are just breathtaking in the current environment. And so it's a very fascinating time to be in the market.
Yeah. I'm curious about this, and this was something that I was talking with our CEO, Stefan Gleason, about a little bit. And he wanted me to ask you if you've noticed any increase in retail investment flows into your funds, mining stocks, bullion. Has anything changed in the last several months? Because there's this perception, I think, that particularly in the U.S., a lot of American investors are still kind of sitting on the sidelines in terms of precious metals, that a lot of this is being driven from Asian and Eastern investment. And do you kind of see that, or do you see more interest evolving here?
Yeah, first of all, I'm a bit in a unique perspective. I wouldn't say that necessarily what I see is representative of what happens in general. But let me just give you what I have seen. One product we have is a closed-end product, meaning we don't have daily flows, so we can see the volume pick up, and we do see somewhat of an investor turnover. Although there's some unique aspects happening at this product that might influence that. We have an open-end product, and I specifically don't list the names because of compliance of it as I have, but where we have seen the buying on the dips. Volume has picked up substantially in that product. It's an exchange traded product where volume has picked up, but net there has been buying activity. The other thing that we see is we work with wholesalers in the precious metals side. And a few months ago, their business was very, they had very little business because there were buyers and sellers amongst the retail dealers. And they cut out the wholesaler. And so there was very little metal ordered from the mint. Whereas in the environment we've had in recent weeks, what has changed is that they're so busy that some of them are hitting their insurance limits in the amount of shipments they can do in a day. And so that suggests that there is demand. And then another corner of this investment world, back to the institutional side, we have started to see that generalist investors of large fund complexes are joining meetings of mining companies that are mid-tier and smaller. And so that is potentially big money that could flow into there. And that's kind of a broadening of the interest. That doesn't mean that they necessarily invest, but having them in the room is something that's somewhat new. But more broadly speaking, yes, it's still a niche. It's still a niche product. It's still a niche market. And I don't think there's a quote unquote frenzy to get into that. And quite the opposite. I mean, what we do see is that the sort of concerns that the gold bugs have always had are moving from the fringe to the mainstream. And there's still a long way for that to be completely mainstream, but the marginal buyer does make a difference. And those forces are firmly in place.
Yeah, that makes a lot of sense to me, because just from my perspective, when I'm talking about some of these things that I've been talking about for a long time, such as the risk of de-dollarization and the problem of the national debt and inflation and these types of things, I'm getting a lot more of nodding of heads in a positive way than I was. It's much less, as you say, kind of not so much of a fringe thing, but a lot more people that are just just your average person out there, I think, are starting to see that. And
yeah, I don't know whether I would subscribe to the in a positive way thing when I hear the national debt, but
well, no,
but as we're talking, the Wall Street Journal has a cover page article about how massive the debt as a percent of GDP is, how expected to rise based on the CBO. Now, obviously, the CBO is notoriously inaccurate in the predictions, but the direction is, of course, right in the sense that there is no effort to get the big spending items under control. We got deficits that are just, let's say, astounding, right? And investors are thinking about what they can do now. Does that mean the price of gold has to go up every day? No, of course not. But it is something that gets the attention of investors way beyond the traditional gold bug.
Yeah. How would you react to this? I read an article today, and it was basically summarizing J.P. Morgan analysts, and they were making a case for $8,000 gold based on this idea that gold is kind of moving from, as you described it, this niche product that is typically seen as a hedge for crises and things like that, to more of a mainstream hedge and an investment in your portfolio. Does that resonate with you as well? I think it does from what you said, but I kind of wanted to put an exclamation point on that. How do you react to that?
The one thing I'd like to just add to that is the precious metals market is small, and when quote unquote Main Street takes note of it, price moves can be substantial. Right, that is really, I think, that is a message that I think people don't realize. We see everything you can buy with a click of a button these days, but it makes a difference whether you go to the treasury market or the gold market. And when people reallocate from gold to precious metals, it has outsized moves in that market. Now, obviously, the gold is not a bond, right? I mean, it's a completely different risk profile, but we do see investors kind of move more towards trying to figure things out. Already in 2005, I I said investors might want to take a diversified approach to something as mundane as cash. And what I meant with that is that the potential for the erosion of the purchasing power of the dollar, do you diversify to other currencies, to precious metals and the like? Then the Eurozone debt crisis came along and nobody wanted to do anything anymore about other currencies.
Right.
But precious metals have, of course, stood the test of time.
So let's talk a little bit about the Fed, because one of the primary drivers, at least this is kind of the theory that sparked the big sell-off, was the announcement of Kevin Warsh as the new Fed chair. And the perception is that Warsh is going to be at least more hawkish than a lot of the other candidates might have been. And he kind of has this perception of being an inflation warrior. And I'm curious if you kind of agree with this analysis of him. And if so, why do you think Trump picked him when he keeps hammering for lower interest rates?
So I have how many hours do we have to talk about Kevin Warsh? Because I love expanding on that. First of all, the sell-off was not triggered by his announcement. The reason I say that is you would have seen that in other parts of the market. What was priced in terms of rate cuts did not budge. It was really a sell-off that was a reaction to the significant leverage there was in various markets, including in the precious metals side. To address the last part of your question, Trump, in my view, chose Warsh because he's the only candidate, or he was the only candidate, who would address the fundamental ailments at the Fed. He has been consistent in his criticism on the communication strategy, on veering beyond monetary policy. Remember, monetary policy is about interest rates, not about micromanaging the economy. He is about getting the Fed to do less. And by doing that, getting the Fed out of the political crosshairs. And some people have said, oh, Warsh has said some of these things because he wanted to get the job. Well, yes, he has spoken up more of late, but he resigned as a governor. He supported the emergency measures in 2008, but then had made it clear that they must be withdrawn immediately and wound down. And when Bernanke did not do that, he resigned out of protest. And ever since then, he's been very, very consistent in that. And so in that sense, he is a back to basics guy at the Fed. Now, I realize that many in your audience don't like the Fed no matter what. But as far as if you have a credit-based system with a central bank, he is the one who can reform it within the confines of existing law. And I say that because if you want to just throw out the Fed entirely, you need something new. Well, guess what? To do that, you would have to go back to Congress. And there are some people that might say that if Congress gets involved, they might mess it up.
They might.
And so kind of Kevin Warsh is the best thing you can get to reform the system from within the given parameters. So that's the second one. The third answer I'll give you on where he stands on policy. Yes, he's historically known as a hawk, but he is also, he has made this very clear in his speeches. He has said that the only way and he's criticized the Fed, by the way, for facilitating deficits with 0% interest rates, egging on Congress to do that. But he has said that the Fed really needs to also be aware that we are going to experiencing a productivity boom. And by the way, so far the data are supporting him. And so he's in the productivity boom camp, whereas Chris Waller, one of the other candidates, he's a Fed president right now, it was more in the camp as, the economy is doing poorly, that's why we need to cut rates. Mm-hmm. And by the way, just to add to that, Powell in December at the press conference started to allude to the productivity boom. And so he basically has been paving the way for a new Fed chair that is on the productivity bandwagon. And it is the key reason, to close the loop on that, why the markets didn't have a violent reaction when Kevin Warsh was announced, because there is a consistency in that sense in the market. There was no utter surprise. I should say, for full disclosure, that I've gotten to know Kevin Walsh over the years. As you may be aware, I'm attending a bunch of conferences where there are folks that are present, and I've really learned to appreciate Kevin Walsh. And so it's going to be super interesting, to the extent that I might be critical of his policies going forward, knowing as much as I know about him, that how to monitor that. And by the way, these things about going back to basics, they're not going to affect the interest rates tomorrow or the day after, right? The economy drives that. And yes, and it doesn't really matter whether interest rates are going to be a quarter point lower or higher tomorrow, but the entire framework matters. And when you're getting more away from this debating club attitude that's always late, to having a more consistent framework, that's all healthy, and in the long run makes monetary policy more efficient when there's less political interference. So it matters on the margin, it matters in the long run, it matters to get the Fed out of politics. Now, Trump will presumably always have something to say when rates move, but he's the right person at the right time for the Fed.
That's a really good analysis of that. I really appreciate that. I know that Walsh has been one of the things he talks about a lot. He talks about rate cuts, but he also talks about the fact that he believes that the balance sheet should be smaller and more streamlined. And he believes that if they can do that, then that will allow them to lower rates on the other side of the scale, which will help Main Street. And I can see the argument there. My question to you is, do you think that he will be able to accomplish that given the issues that we have in the bond market? Is it realistic for the Fed to be able to shrink its balance sheet in this environment?
Well, here I'll give you just my personal opinion, because I don't know the exact details of what Walsh has in mind. There's one thing he said, that he's going to work with Treasury. Clearly, it makes no sense that both Treasury and the Fed are managing duration, and so swapping the portfolio with Treasury, dumping the bonds onto Treasury and getting T-bills or something, I think is a good idea. But that itself, of course, doesn't allow you to that allows you to get out of duration management on the Fed side, even if it was never intentional. But that doesn't shrink the balance sheet itself. The way you can shrink the balance sheet is you go back to the pre-2008 way of managing interest rates, by having the New York Federal Reserve intervene in the markets and manage interest rates through open market operations. Now, I have to tell you, the folks at the New York Fed that I have talked to don't like that at all. They think it's an arcane thing that is super stressful, and there's no benefit in it. I am in the camp that says, no, it is absolutely worthwhile to go back to that. Paying interest on reserves, as the current model is politically a nightmare, because you're paying tens of billions to banks. And when you intervene in the markets to set rates, which you can do, the reason, by the way, can be done is then you can go back to a minimalist balance sheet. Then you don't have to have this huge balance sheet. If you do that, you see problems spike up when you you just foam the runway, so to speak, all the time. You don't see underlying problems, but when you manage the rates with the daily interventions, you see problems flare up before they become huge issues. Now, that's one of the things I would love to see. I don't know whether Kevin Walsh is on board with that, but that would be the way to lower the balance sheet. Otherwise, if you just lower the balance sheet from where you are without doing anything else, it doesn't work, because we've seen it, that then there's some crisis somewhere happening. Yeah. And so we will see of what he will do. He obviously needs to get the other folks on the Fed on board with whatever he does. Some people say he's been a bit antagonistic, and yes, he's had a sharp tongue, but from how I've gotten to know Kevin Walsh, he's actually quite a team player, and I wouldn't be surprised if he can get people on board on whatever he's planning to do. Maybe he won't achieve everything he wants to do, but I think he can get quite a bit done.
That's good to hear, because that was one of the things that I was going to comment that I was making, or at least it ran through my head, is that, this is one guy among a number of board members, and you've got all of the various presidents and stuff. So the fact that he has that ability will bode well.
Yeah. Well, leadership matters. And I say that in particular, let's take communication strategy. Right now, every Fed president seems to want to be on CNBC when there's some economic data released. And when you ask them, they say, well, we scheduled this weeks ahead of time, months ahead of time. I didn't know. Well, yeah, you know that economic data released that day, right? And why do you comment live on economic data anyway? And then the other thing you hear is that the Fed presidents don't really report to the chair. They are really independent. But I am certain that if the chair sets the tone and tells them to behave and do certain things differently, that will have an influence. Now, that doesn't guarantee that every Fed president is always going to do exactly what the chair does. But we've had, obviously, there have been numerous scandals at the Fed. And is it just tough coincidence that those things happen and not? I mean, Besant, the Treasury Secretary, said if this were to happen at a big corporation, the CEO would be out. Now, obviously, that's playing into the administration's drive to kind of cause some pain for Powell. But he's making a point, right? A good point that they need to run a tighter ship. And so having new leadership there helps. And we talk about Walsh here. Powell is a lawyer, in some ways an administrator. He was not providing thought leadership, I don't think, on anything. I mean, take the 5-year review that they do. There was nothing that came out of that. And so people may or may not appreciate everything that Kevin Walsh is going to do, but at least there's a guy who has a vision on how to take things. And I mean, I'm certainly going to give him the benefit of the doubt to give him a chance. Now, that just as a caution, that doesn't mean that he can fix the fiscal problems. That's
right. No, that's not his job.
Still going to be around, right?
Yeah.
He can help not to make it worse.
Right. Well, that's good to hear. I really appreciate that insight on him, and the fact that you know him. That really kind of helps adds a little bit of credibility to what you're saying. So I appreciate that. I'm going to get you out on this.
Again, I take no claim that I'm going to be right in anything that I say. But
absolutely,
my opinions are not based on my own analysis.
Yeah, exactly. And I think that's a healthy attitude to maintain. I'm going to get you out on this one. This is just kind of a fun question, and my colleague Josh wanted me to ask you this, but I think it's a fun question. Do you have a favorite coin or bullion product that you really like? And if so, why do you like that particular thing? And it doesn't have to be because of any kind of financial thing, just because you happen to like it.
Well, I'm biased, right? We manage a physical gold exchange traded product. I cannot name the name here because then there's different things that are triggered. But quote unquote, that's my favorite. So you can go to merkinvestments.com and then go from there. It's a product where you can buy gold on the exchange and take delivery if you want to. Mm-hmm. But I guess the question is always the proof in the pudding, right? I own quite a few shares in that. Other than that, I own a bunch of kilobars, which is maybe not so sexy. But fun fact that some of viewers may not know, in 2003, I started a golden college savings fund where every year I looked at the year of a 4-year college, an expensive one, and then started planning. At the time, we had little kids. At the time, we only had 3 kids. We later had the 4th one. And how much gold do you have to put aside each year so that by the time that the youngest is 21, you've paid for college? And the price of college tuition went down every year when priced in gold. And so that was a positive. And then just fast forward, one of our kids had one of these expensive college experiences. Number 2, we were very lucky. She's a college dropout, does the startup world. And then 2 others went to state schools, or the last one is still in that. And so in that sense, the kilobar, if you're talking about the physical space, it's been the most popular one in what I have, at least. I do have some other coins as well, but I think that's might be a little different answer than you get from others. So that's my answer.
Well, that's a great answer. I love it, and I love that you're saving for your kids' education in gold. That's really, really cool. Well, before I go, I do want you to. You mentioned the website once, but I do want you to very specifically point folks to your website and where they can go to learn more about what you do and maybe get a little bit more information than you're at liberty to give in an interview?
Sure. Merkinvestments.com is our website. We manage over $4 billion in gold and gold miners. I'm on social media at Axel Merk. I can't talk about products on social media, but you will get my musings on the latest, be that on Kevin Walsh or the deficit or gold. And I'm quite reachable, so feel free to reach out anytime. We do have a free newsletter at merkinvestments.com as well that you can subscribe to.
Very cool. Your X feed is one of my favorites. I really do enjoy, like I said, just because you give this balanced thing, and I always feel like you're making me think as opposed to trying to convince me of something. So
by not being radical, I don't splash as much as others do. But the reason I do it anyway, even if my tweets don't get much traction sometimes, is instead of taking notes that I can't read anyway because I can't read my handwriting, when I listen to a press conference, I tweet because that helps me memorialize what happened. And those who care get to see it, and those who don't, well, they don't. But I do it for my own sake as much as for anybody else's.
Yeah, I've done that before too. I often use comments on like Facebook just as note cards. You know, somebody will make a comment and I'll write something really long, which isn't really for them at all. It's because I want to formulate my ideas on that. So that's a good strategy. Well, I always enjoy talking to you. You're a pleasure, and I really appreciate you taking a little time out of your day to hang out with me. So I hope you have a great rest of your week, and I'm sure we'll have you back on in the next few months.
Have a golden day. Yep.
You too.
Another good interview, and we always love getting Axel's insights, and I hope you enjoyed that discussion. Well, that will do it for this week. Be sure to check back next Friday for next weekly Market Wrap podcast. And remember to tune in as well to Money Metal's Midweek Memo, hosted by Mike Meharry. To check out any of our audio programs, just visit moneymetals.com/podcasts or find them on Spotify, Apple Podcasts, Google Podcasts, or wherever you listen to your favorite podcasts. And it's a big help to us. We would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.